Given the kind of volatility currently present in the market, and the sharp movements in both directions within a very short duration, retail traders are suffering substantial losses. Based on this, you also have to speed up your chart analysis along with your trade entries and exits. Only then will you be able to withstand this market. Hence, if you buy options in intraday options trading, it can be advantageous to operate in a scalping style instead of a positional trading style. Scalping demands you to place trades very quickly and exit them with profits just as fast. So, you need to trade within smaller time frames. If you try to scalp on larger time frames, you will be forced to apply wider stop losses and targets accordingly, which can impact your risk to reward ratio. Therefore, today we will discuss some key methods for initiating trades with smaller stop losses in smaller time frames. The 1-minute time frame. Let's begin, but before we proceed, if you think this content is valuable, smash that like button. And if you are new here, make sure to subscribe and enable notifications so you never miss our latest uploads. I'll catch you right after the intro and disclaimer. Before learning these techniques, we should also remember that what we will be doing is scalping in small time frames like 1 minute. Therefore, here you will often notice fake trade entry signals appearing at incorrect spots on the chart, and retail traders can easily enter and exit trades repeatedly by acting on these signals. Hence, if a trader places at least 5 trades a day, he will end up paying approximately 1 per executed order per day and 2,000 for 20 trading sessions in a month solely as brokerage. If you trade 10 times a day, you will have to pay 48,000 in a year just for brokerage, which is a massive expense for a retail trader. Let's continue. Scalping technique number 1. Identify double top and double bottom patterns. Double top and double bottom chart patterns are regarded as the most effective trade entry patterns because they can help you assess the mindset of buyers and sellers at a specific level or zone. For instance, due to selling pressure from sellers at upper levels, the price drops but fails to break the lower level and reverses from there. This indicates that buyers at lower levels are unwilling to let the price fall. Watching the price rise, as soon as it returns to its earlier high, fresh sellers enter the market and push the price down again. However, this time, buyers boost their buying pressure from below, causing the price to attempt another rise. Now, because sellers sold at this point initially and again at this point, yet still failed to drive the market lower, it suggests that the strength of sellers has weakened compared to the previous high, and their last effort has also failed. Buyers capitalize on this situation and actively purchase near the support area, causing the market to move upward. For example, if you observe the Nifty 50 chart on the 1-minute time frame, after the first candle in the morning, sellers push the market downward but do not manage to take it below the first candle's low. A second time, sellers press the price down, but once again, the price finds support at the same level and climbs back up, breaking its prior swing high. This indicates that sellers have lost strength and failed to keep the price suppressed. Therefore, if you take a long trade by setting a stop loss slightly below this breakout candle, you should aim for a profit target twice your stop loss. Shortly after, the price spikes rapidly from here and reaches your profit target. This shows that a double bottom pattern reflects weakening sellers and strengthening buyers in the market. Additionally, if this pattern appears near a support area on the chart, it can yield the best results. Hence, if the market is bullish in the larger time frame, you can anticipate a double bottom pattern near the support area in the 1-minute time frame. In the double bottom pattern, we can take a long trade by using the neckline of the pattern. After a breakout, we plan our trade entry and set our stop loss below the breakout candle. However, many times, a large double bottom pattern develops on the chart. As seen in this Bank Nifty chart, a bigger double bottom pattern has formed on the chart, where the price falls around 200 points from its earlier high before climbing again. Now, if we place a stop loss below the breakout candle of this pattern's neckline, it will be a very small stop loss considering the market's volume. However, if you take a small risk and capture such a big move on the chart, then the second time the price tries to break above support, you can enter with a small stop loss near support and place a profit target up to the swing high, which will keep your risk to reward ratio balanced. In the same way, when the price rejects twice at upper levels in the market and then drops, it can be referred to as a double top pattern. As seen in this Bank Nifty chart, the price attempts to rise right after the market opens. It moves downward after facing resistance near the 42,800 levels at higher points. After a while, buyers once again attempt to drive the market upward, but this time as well, the price rejects near the same resistance area and then breaks below the small range created here by a bearish candlestick pattern, a 3 inside down pattern, on the chart. This indicates that buyers have failed twice to push the price upward. Now, you can plan a short trade by placing your stop loss above this swing high. However, this does not imply that just because we have taken a short trade, the market will only decline. It is possible that the market could break this swing high and continue upward. We only need to look for a low-risk, high-probability trade setup on the chart where our profit target is bigger than our stop loss. Therefore, our focus should always remain on risk management. Even if the market moves upward from here, our small stop loss will get triggered. However, in a short span, the price declines, breaking its previous swing low and closing below it, reaching our profit target. Let us now move on to the second trade entry technique. Technique number 2, range breakout entry setup. In a range breakout entry setup, whenever the price, after trading in a range for some time, moves upward, if it breaks out of that range, then trades are taken in the direction of the breakout. Frequently, price creates clear ranges on the chart. For instance, here, price is taking support near a single support line and trading in that zone. In the same way, here, the market is trading below a single trend line while declining, receiving rejection from it, or repeatedly using a trend line as support. In this kind of chart pattern, large institutional traders manipulate the emotions of retail traders. For example, today, after the market opened on the Nifty 50 chart, the price paused briefly near the 23,900 level and moved within a small range. After breaking out of that range, it quickly went upward and then dropped again, breaking this support. This is how small retail traders get played in the market. To benefit from this kind of breakout, you can enter the trade at the high of the breakout candle and put your stop loss below its low. In the same way, if you were trading Nifty 50 from 12 noon to 1 p.m., and if you check the 10-minute chart, after falling sharply, the market trades for a long time in a small range by forming small candles. But this range gets broken at 12:54. It breaks and moves rapidly upward. Whenever buyers and sellers in the market are uncertain about direction, the market tends to trade in a range because they are unsure where to go. However, as soon as a breakout happens in one direction, buyers and sellers immediately start placing trade entries in that direction, causing the price to move quickly that way. In this type of trade, you should never enter without placing a stop loss. Now, since we are trading in a small time frame like 1 minute, the chances of fake breakouts are equally high. Therefore, using a stop loss is necessary. You can adjust your stop loss based on the candle size forming on the chart, which reduces the risk of your stop loss getting hunted. Technique number 3. Using the MACD histogram. If you want to identify the strength of buyers and sellers in a specific market, you can use the histogram of the MACD indicator. In this chart, as the price falls sharply and starts trading in a range, a dark red bar appears in the histogram below. Pink bars begin forming instead of red bars. This indicates sellers are becoming less active in pushing the market down, which is why the bars in the histogram are shrinking in size and their color is changing. If the market is dropping and pink bars are forming in the histogram instead of red bars, and their size is decreasing, it means sellers are losing strength. In such a situation, you can take a long trade on a breakout with a small stop loss. For instance, when the Nifty market trades in a range, the color of the bars in the histogram changes and their size also reduces. This means sellers are weakening, and buyers can take charge of the market at any moment. Hence, as soon as this range is broken, the market instantly moves up sharply. With the help of the histogram, you can anticipate potential reversals in the market and plan your trade entry accordingly. For example, if you see a green bar in the histogram when the market pauses at this level for a while after a sharp rise, and if you observe the bars changing from dark green to light green and their size also getting smaller, it means buyers are gradually exiting their positions and are less interested in pushing the price higher. Due to reduced buying pressure, the price falls again. In the same way, you can use the histogram to identify reversal trade entries. That's it, traders. Thanks for watching this video. Improvement starts the moment you decide to take things seriously. If today's content brought you clarity, make sure to hit the like button, it really helps. And if you're just joining the channel, subscribe and activate the notification bell so you never miss a new upload. Keep pushing, keep learning, and keep setting higher standards. I'll catch you in the next one.